Okay, so imagine this. You wake up on a Monday morning. You get dressed, grab your coffee, head to work, just like any other day. You get to the building, and your key card doesn't work. You try again. Nothing. You look around and you see your colleagues standing outside too. Some of them are on their phones. Some of them just look confused, scared even. And then someone shows you their screen, and you see it. The company you've worked at for years, the place you showed up to every single day, is gone. Not struggling, not in trouble, gone. That's exactly what happened to tens of thousands of people on the morning of September 15th, 2008. The company was called Lehman Brothers, and if you've never heard that name before, by the end of this video, you will never forget it. Because what happened to Lehman Brothers didn't just destroy one company. It triggered a global financial crisis that wiped out trillions of dollars, put millions of people out of work, and cost ordinary families, people who had absolutely nothing to do with Wall Street, everything they had built. And the craziest part? The warning signs were there the whole time. So today we're going to go through the whole story, from the very beginning, and I'm going to explain it in a way that actually makes sense. No jargon, no complicated finance talk. Just the truth about what happened, why it happened, and honestly, why it could happen again. Let's get into it. To understand why Lehman collapsed, you have to go back. Way back. Not to Wall Street, not to New York, to a small shop in Montgomery, Alabama, 1844. Three brothers, Henry, Emmanuel, and Mayer Lehman, had just arrived from Bavaria, Germany, immigrants with almost nothing. They opened a general goods store, sold flour, sugar, tools, whatever people needed. But here's what changed everything. Their customers didn't always pay in cash. They paid in cotton. And cotton in the American South in the 1840s was worth everything. So the Lehman Brothers did what smart people do. They followed the money. They became cotton traders, then commodity brokers, then financial advisors. Within 2 decades, they had moved to New York and were trading on Wall Street. What happened next is remarkable. Over the next 100 years, Lehman Brothers survived everything the world threw at it. The Civil War, the Panic of 1907, the Great Depression, World War I, World War II. Every time the economy crashed, Lehman found a way through. By the 1970s, they were advising some of the biggest companies in America. By the 1990s, they were one of the most respected investment banks in the world. And by 2006, the year before everything started to fall apart, Lehman Brothers posted a record profit of over $4 billion. $4 billion in 1 year. The stock was at an all-time high. The bonuses were enormous. The future looked limitless. But underneath all of that success, a very dangerous crack had started to form, and it had a name: housing. Here's the thing about the housing market in the early 2000s. Everything looked perfect. House prices had been rising for years. Interest rates were low. People were buying. Banks were lending. The American dream felt more achievable than ever. But something was changing behind the scenes. Banks, under pressure to grow, started lowering their standards dramatically. Normally, if you want a mortgage, a bank checks everything: your income, your employment history, your credit score, your savings. They want to know, can this person actually pay this money back? But in the early 2000s, that changed. No stable job? Here's a mortgage. No proof of income? Here's a mortgage. No savings? No problem. Here's a mortgage. These were called subprime mortgages, loans given to people who, under normal circumstances, wouldn't qualify, and banks gave out millions of them. But it gets more complicated. Banks didn't just hold these risky loans. They packaged thousands of them together into investment products called CDOs, collateralized debt obligations. Then they sold these packages to investors around the world. And the pitch was simple. Yes, each individual loan might be risky, but together they're diversified. They're safe. Lehman Brothers didn't just buy into this idea. They dove in head first. By 2007, Lehman was holding over $85 billion in mortgage-related assets. $85 billion. That's more than the GDP of most countries. And for a while, it worked perfectly. House prices kept going up. People kept paying. Profits rolled in. Then came 2006, 2007, and house prices stopped going up. Then they started falling. And when they fell, everything unraveled. Millions of people who had been given mortgages they couldn't afford started missing payments, then stopped paying entirely. The packages that were supposed to be safe were suddenly worthless, and Lehman Brothers was sitting on a mountain of them. The ticking had started. By 2007, Lehman's leadership knew they had a problem. A serious one. They were holding tens of billions in assets that were rapidly losing value. If investors, or regulators, saw the real numbers, panic would spread immediately. The stock would crash. Confidence would evaporate. So they found a solution, a creative one. It was called Repo 105. Here's how it worked, and I'll explain it as simply as possible. Every quarter, companies have to publish their financial statements. These statements show how much debt you have, how much you own, how healthy you are. Lehman was required to do this. But right before each quarterly report was published, Lehman would quietly move tens of billions of dollars in assets off their books temporarily. Not a real sale, a temporary one. These were called repurchase agreements. They'd shift the assets out with a secret agreement to bring them back just days after the report was filed. But for the brief window when the report was being written, those assets were officially off Lehman's books. The debt looked smaller. The balance sheet looked healthier. Everything looked fine. Then, the moment the report was public, they brought everything back, and the massive debt was back too. Nothing had actually changed. They were misleading investors, quarter after quarter after quarter. It's like cleaning your house by throwing everything into a closet right before your guests arrive, and then watching them leave, relieved, before pulling it all back out again. This went on for years, and almost nobody outside of Lehman knew. We're now in the second week of September 2008. The cracks are visible to everyone. Lehman's stock has lost 95% of its value since January. Confidence is evaporating. Other banks are refusing to lend to them. And behind closed doors, the government knows. Friday, September 12th, 6 p.m. The heads of every major American bank are called to an emergency meeting at the Federal Reserve Bank of New York. Treasury Secretary Hank Paulson is there. Fed President Tim Geithner is there. The message is blunt. Lehman is going down, unless someone buys them. Tonight. Two names emerge as possible buyers. Barclays, the British bank, and Bank of America. Negotiations begin. Saturday morning, talks continue. There's still a chance. Barclays seems interested. Bank of America is circling. But both want one thing Lehman can't offer: a guarantee from the government that they won't lose money on the deal. And here's the critical decision that changes everything. Unlike Bear Stearns, which had been bailed out just months earlier, the government decided Lehman would not get a bailout. The message from Washington was clear: you made your bed, you lie in it. Saturday night, Bank of America walks away. They're buying Merrill Lynch instead, another struggling bank, which they consider a better deal. Sunday, Barclays is still talking, but British regulators won't approve the deal fast enough. UK law requires a shareholder vote that would take weeks. Weeks Lehman doesn't have. Sunday night, 11 p.m. The decision is final. There will be no rescue. There will be no buyer. There will be no bailout. Lehman Brothers, 158 years old, will file for the largest bankruptcy in American history. The papers are signed at 1:45 in the morning, and when the markets open 5 hours later, the world changes. When the markets opened on the morning of Monday, September 15th, the reaction was immediate. The Dow Jones fell 504 points in a single day, the biggest single-day drop since September 11th, 2001. But that was just the opening shot. What happened next was a chain reaction unlike anything the modern world had seen. Other banks, who had done business with Lehman, who had lent them money, who were exposed to the same risky mortgage assets, started to wobble. The credit markets froze. Suddenly, banks wouldn't lend to each other. And if banks won't lend to each other, they certainly won't lend to businesses. And if businesses can't borrow money, they can't pay their employees. And if employees don't get paid, they can't pay their mortgages. You see how this cascades? Within weeks, the crisis had spread from Wall Street to Main Street, from New York to London, Paris, Tokyo, Dubai. In the 18 months that followed, the global economy lost over $2 trillion in wealth. 8.7 million Americans lost their jobs. Millions more lost their homes. Retirement savings? Gone. College funds? Gone. Businesses that had nothing to do with mortgages, nothing to do with Wall Street? Gone. The average American family lost 20% of their net worth. In some communities, particularly lower-income neighborhoods, the devastation was even worse. And this wasn't just an American problem. Iceland's entire banking system collapsed. Greece entered a decade of austerity. The global recession that followed cost the world over $10 trillion in lost economic output. $10 trillion from one bank in one weekend. And ordinary people, who had never heard of Lehman Brothers, who had never bought a CDO, who had never set foot on Wall Street, they paid the heaviest price. While all of this was happening, while millions lost their jobs and their homes, there was one man at the center of it all. Richard Dick Fuld, Lehman's CEO. Fuld ran Lehman for 14 years. Under his leadership, the company became enormously profitable, and so did he. Between 2000 and 2007, Fuld earned an estimated $529 million in total compensation. $529 million. He was known as an aggressive, intimidating leader, someone who believed Lehman would always find a way to survive. He believed, genuinely, that the company would make it through, even as the warnings mounted, even as the assets turned toxic, even as the system cracked. When he testified before Congress in October 2008, he was asked directly, "Do you take responsibility for what happened?" He said yes, but also said he had done everything right. Dick Fuld was never criminally charged. He faced no prison time, no major personal financial consequence. He was later reported to have quietly sold his Florida mansion to his wife for $100 to protect the asset from lawsuits. $100. The man who earned $500 million sold his house for $100. Meanwhile, teachers, nurses, factory workers, and retirees who had done everything right lost everything. That asymmetry is still one of the most infuriating parts of the 2008 crisis, and it never fully went away. So what do we take from all of this? Because this isn't just history. This matters right now. Lesson 1. Big institutions fail slowly, then all at once. Lehman didn't collapse in a day. The warning signs had been building for years. People inside the company saw them. Analysts saw them. Some investors saw them. But nobody with the power to act did. Lesson 2. Complexity is a tool for hiding risk. CDOs, Repo 105, subprime bundling, none of this was simple by accident. When things get too complex to understand, that's often when danger hides best. Lesson 3. The people who take the risks are rarely the ones who pay for them. Dick Fuld earned $529 million and faced no criminal charges. Millions of ordinary people lost their homes, their savings, their futures. In 2010, the Dodd-Frank Act was passed. New rules designed to prevent another 2008. But many of those rules have since been weakened, and the system that created 2008, in many ways, it still exists. Which brings me to the question I want to leave you with. If a 158-year-old giant, one of the most respected institutions on Earth, can collapse in a single weekend, which company do you think is next? Drop your answer in the comments. I read every single one. And if you want to go deeper, I'll be doing a full breakdown of Bear Stearns, AIG, and the bailouts that followed. Subscribe so you don't miss it. See you in the next one.